This video is for the person who knows they should be investing, but still hasn't started. Maybe you're waiting to save more money first. Maybe you think you need thousands of dollars. Or maybe you're just not sure where to begin. Whether you have $50, £100, or the equivalent in any currency, this is where you start. Because there is one belief that keeps more people out of investing than anything else. And the strange part is, it sounds responsible. It sounds patient. But in reality, it quietly destroys progress. The belief is this: I'll start investing when I've saved enough money. Here's what actually happens. You save for a few months. Then life happens. A medical bill, rent increases, your car breaks down, a family emergency comes up, and suddenly the savings disappear. So you start rebuilding. Then life happens again, and before you know it, you never quite reach enough. 5 years pass, then 10. You're older, still trying to start, with roughly the same net worth and a quiet frustration you can't fully explain. Robert Kiyosaki once wrote in Rich Dad, Poor Dad, "The poor and middle class work for money. The rich have money work for them." That single sentence explains the structural difference between people who build wealth and people who stay stuck. The real question is not how much you start with. The real question is when you start. And the correct answer is not later. Before we talk about how to invest, you need to understand one concept that sits at the center of wealth building: compounding. Compounding is one of the most talked about ideas in finance, but also one of the least truly understood. Everyone hears about it. Almost nobody feels its power until much later. So let's make it very real. Albert Einstein is often credited with calling compound interest the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Whether he actually said it is debated, but the math is not. Let's say you invest $200 every month. That's about $6 or $7 a day, roughly the cost of a coffee and a snack in many cities. Now, imagine that money goes into a broad stock market index fund, earning around 10% per year, which is close to the long-term average of the US stock market. Here's what happens. After 10 years, you would have invested $24,000. Your portfolio would be worth about $38,000. After 20 years, you would have invested $48,000. Your portfolio would be worth around $152,000. After 30 years, you would have invested $72,000, and your portfolio could be worth more than $450,000. That means more than $378,000 came purely from compounding. Money generating more money, without you working extra hours, without a second job, just time and consistency. Now here's the painful part. If you wait just 5 years before starting, same monthly investment, same return, you could lose over $200,000 in final value. Not because of a bad investment, but simply because you waited. That's why time is the most expensive thing you spend when you delay investing, and it's the one thing money can never buy back. Now, before you invest even a single dollar, there are 2 non-negotiables you cannot skip. Ignore either one, and investing may work against you instead of for you. The first is high-interest debt. If you're carrying debt like credit cards, payday loans, or anything charging 15 to 20% interest or more, you need to pay that down first. Why? Because no sensible investment strategy consistently beats a 25% debt burden. Trying to invest while carrying high-interest debt is like filling a bucket that has a large hole at the bottom. You're building wealth with one hand while destroying it with the other. So eliminate the expensive debt first. The second non-negotiable is an emergency fund. You should have at least 3 months of essential living expenses saved. That means rent, food, utilities, transport, the basics. And this money should stay liquid and easily accessible, not invested, not locked away in something you can't touch. A high-yield savings account or a money market fund works well for this.
This is not about maximizing returns. This is about protection. Think of it as financial armor. Without it, one unexpected expense can force you to sell investments at the worst possible moment. With it, your investments are free to grow without constant interruption. Now, let's talk about what you can actually invest in. The best starting point for most beginners is something very simple: index funds, or ETFs. These funds simply track the overall market, and they have one of the strongest endorsements possible. Warren Buffett, one of the greatest investors in history, has repeatedly said that for ordinary people, a low-cost S&P 500 index fund is one of the best investments available. Not individual stocks, not options, not crypto, just the index. In fact, in his 2013 letter to Berkshire Hathaway shareholders, he said that when he dies, 90% of his own family's investment money should go into an S&P 500 index fund. Think about that. One of the greatest stock pickers in history telling ordinary investors not to pick stocks. That should tell you something. If you're in the United States, platforms like Vanguard, Fidelity, and Charles Schwab make this easy. If you're outside the US, platforms like Trading 212, eToro, Interactive Brokers, or Bamboo for Nigerians can provide access to global markets. You can also hold money in high-yield savings accounts or money market funds for your emergency savings. And in many countries, government bonds or treasury bills offer relatively safe returns backed by the government. For investors in countries where the local currency weakens over time, holding part of your investments in strong global assets like US stocks is not speculation, it is simply wealth preservation. Now, when it comes to individual stocks, start with the index first. The evidence is very clear. Most individual investors who try to pick stocks end up underperforming the broader market. You can explore individual stocks later, but not as your starting point. Now, here is the strategy, and it's incredibly simple. Pick a fixed amount to invest every single month. Treat it like a bill, non-negotiable. The money leaves your account before you decide what to spend on anything else. This strategy is called dollar cost averaging. You invest consistently whether the market is up or down. Over time, you naturally buy more when prices are low and less when prices are high. You don't need to predict the market. You just need to stay consistent. And whenever possible, automate it. Set the transfer, remove the decision. Because most investors don't fail because they picked the wrong investment. They fail because they keep trying to time the market, waiting for the perfect moment. But the perfect moment rarely comes. There is no perfect time. There is only consistent time. And after you invest, you do the hardest thing in investing: nothing. Stay patient. Markets will fall. Your portfolio will turn red. The news will panic. People around you will panic. Headlines will say, "This time is different." Most of the time, it isn't. The investors who build real wealth are not the most active. They are the most patient. Now, here's something important. Everything in this video is information you could have found before today. So why haven't most people started? It's not because they lack knowledge. It's because of their identity. Most people simply don't see themselves as investors. To them, investors are wealthy people in suits making decisions on Wall Street. Not someone like them. Not yet. Maybe when they earn more. Maybe when life becomes stable. So the information gets heard, appreciated, and quietly ignored. But James Clear wrote something powerful in Atomic Habits. Every action you take is a vote for the type of person you want to become. Investing $50 this month is not just money in a brokerage account. It is a vote. It says, "I am someone who takes my financial future seriously. I am someone who builds wealth, not just earns income. I am someone who understands that wealth is not a single event. It is a habit repeated over time." So, cast that vote today. The amount you start with matters far less than the fact that you start, because the real transformation is not financial. It is identity. Here's a simple starting checklist. Clear high-interest debt, build 3 months of living expenses in a liquid savings account, open a brokerage account, choose a broad market index fund, Pick a monthly amount you can comfortably invest. Automate it. Leave it alone. Repeat for years. That's the entire playbook. Simple, but incredibly powerful. And almost nobody who followed it consistently for a decade regrets starting. If this video helped you, subscribe. Every week I share insights about investing, money psychology, and how to build real wealth from wherever you're starting. And in the comments, tell me this: what is the one thing in this video you needed to hear the most? I read every comment, and I'll see you in the next video.